Market Musings Podcast with Fairbairn and Russell. Hello and welcome to the Market Musings Podcast, where today we're going to be talking about diamonds, but not from the exploration side, which is often where we focus things on this podcast. No, today we're going to be looking at diamonds from the commercial aspect and peering behind the curtain of this somewhat mysterious precious stone. Paul Zimnisky joins us today from Diamond Analytics, which is an independent data analysis and consulting proprietorship specializing in the global diamond industry. Hello, Paul. Welcome to the Market Musings podcast. How are you?
Great. Thanks for having me.
It's good to be talking to you. And alongside me today, my co-host Lois. Welcome.
Thank you.
Do you have any diamonds then, Lois? Do you like diamonds? Do you own any diamonds?
Sadly, not yet.
Not yet. Me neither. I have no diamonds around yet, but that might change after today's podcast. So the first thing we'd like to do on this podcast, Paul, is just maybe for 2 or 3 minutes, just get a bit of an introduction to yourself, a bit about your background, how you ended up in the diamond industry and what led you to where you are today. So the floor is yours, if you can, for the next minute or two. Just give us a bit of an introduction to Paul.
Yeah, so my background's as a Wall Street analyst, and I started out covering natural resources and commodities more generally, and diamonds represented a really small part of the work that I did, but I just always kind of thought it was an interesting industry, and over the years I started covering it more and more until I got to the point where it became kind of maybe more of an independent specialty for me. So I cover the whole supply chain. I like to look at the more macro side of the business, whether it's global diamond supply, demand, but then there's all these interesting intricacies within the industry. I think some of them we're gonna talk about today. But so I would say I primarily focused, what I do, working with institutional investors, looking to understand, the industry better. But as my business has grown, I also work, quite closely with a lot of the companies in the industry and governments and universities and intergovernmental organizations and that sort of thing. So I pretty much try to cover it all. And it's a very interesting industry. It's very global in nature. It covers a lot of cultures. Like you said, you have the mining side, the geology side, then you have the fashion side of the business and the jewelry design. You have kind of the marketing angle of it. There's a lot of components to it that really make it a fun industry to cover.
Mm-hmm. How did you fall into it?
It was more just a curiosity. Again, when I covered it, I was working for a hedge fund, and I was a buy-side analyst. And it was anytime we would look at the space, it was kind of very difficult to get reliable information on the industry. It's kind of small, it's niche. A lot of people don't cover it, but I kind of thought there was an opportunity because of that, and it kind of always intrigued me because of that.
Okay. Well, I was looking around on your website, and I think I found an article that I think you wrote where you're sort of doing a state of the market, and I noticed the quote that you said, it's the strongest it's been in 10 years. So can you give us a bit of a state of the market on diamonds in a minute or two?
Right. So I think you got to kind of maybe go back, let's go back a decade. So you go to kind of the global financial crisis, and obviously we had credit issues across, pretty much every industry, including the diamond industry, and that really significantly reduced supply. A lot of the mining companies, had to put mines on care and maintenance. So there was this huge drop in supply, 2009, 2010, 2011. But at the same time, there was this huge surge in demand where Chinese consumers started giving diamond engagement rings for the first time. You're starting to see the consumer discretionary market in China really start to explode, and that certainly benefited diamonds. So you had the situation where supply was significantly curtailed because of the global financial crisis, and you had this huge surge in demand from China, and it pushed diamond prices to an all-time high in the first half of 2011. And in the subsequent years, that high price kind of led to new diamond exploration and development. And then by the end of the decade, there was a significant amount of new supply coming online, and we kind of went from an undersupplied market to an oversupplied market, and diamond prices have been relatively, apathetic, I would say, for most of last decade. Prices were kind of flat to down. in a lot of the categories. And now we're kind of seeing the opposite happen, where prices have kind of been apathetic enough where there really hasn't been a whole lot of diamond exploration and new developments. So you're starting to see kind of, some of these legacy mine supplies kind of coming off. You're seeing some of these older mines close, and we're having a situation where, supply is starting to significantly come in again. And then you have the kind of the boost from the pandemic, where you have, all of the stimulus, and the demand market for diamonds is primarily U.S., China, India, and you're seeing significant stimulus in those markets. Consumer spending is up significantly. People aren't spending money traveling internationally, or going to expensive sporting events, or going to expensive dinners. They're spending their discretionary capital on hard luxury items like diamonds. So diamonds have done exceptionally well during the pandemic from a demand standpoint. And then, there were supply chain disruptions as most industries experienced. So you had kind of a similar situation to 2011, where, we had a strong boost in demand and a curtailment of supply. And, it's pushed prices up this year. And I have a proprietary rough diamond index, and I, estimate that prices are up, some 18 to 22% year to date 2021. So it's been a good year from the industry from that standpoint.
And are the prices really driven by consumers buying diamonds?
Yeah, so I think long term it is. It's end consumer drives diamond prices. I think when you look at the way that the structure of the industry and the way that at least rough diamonds are priced, you have probably 2/3 to 3/4 of diamonds are sold via contract sale, and that's whether it's De Beers or the Russian major Alrosa, some of the large mining conglomerates, Rio Tinto. So these companies historically have sold via contract, and I would say it's more similar to the way that uranium sold on long-term contract, or potash, the fertilizer. So it's kind of a unique market from that standpoint. But at the end of the day, it's end consumer demand that drives prices, and we kind of again, we saw that last decade, and we've also seen it during the pandemic, where we see that huge surge in consumer demand. And at the end of the day, that's what's ultimately going to drive prices higher in the longer term.
Okay.
So you've mainly touched upon kind of natural diamonds, so the mining of natural diamonds, but also recently we've seen kind of rise in synthetic diamonds. What does it have impact on the market of natural diamonds as well?
Yeah, it's a good question. So it's early stages of this. So we've had the technology to produce synthetic diamonds for decades now, probably the 1950s, 1960s, but the very large majority of that is diamond produced for abrasive applications, whether it's construction equipment, mining equipment, that sort of thing. And it's just been within the last few years, probably the last 5 years or so, that we've really started to see, the emergence of synthetic diamond, sold as jewelry. So it's still in the early stages. Right now, it represents probably a mid-single digit percentage of the market. So it's still relatively small. And the pricing differential between the two is quite significant. It's man-made diamonds are, when we look at the jewelry, they're, anywhere from, 50 to 75, 85% cheaper than a natural equivalent. So I think as the technology to produce them, improves, prices come down, and that differential in price, that I think is further segmenting, the way that consumers are perceiving the product. That said, I think it's an interesting product. Again, the price differential makes it, I think, possible for consumers that maybe historically wouldn't be able to afford a natural diamond can now afford a nice man-made diamond. So I think it's going to be a newer segment of the market. I think when you look at the fashion jewelry companies that typically sell, say, lower price point jewelry that's, maybe more geared for everyday use, like the Pandoras and the Swarovskis of the world, I think it's an ideal product for companies like this. And then I think there will be some premium brands that can, market man-made diamonds as a high-end premium product that competes a lot more with natural diamonds. But I think it's going to cost a lot of branding and marketing dollars to get to that point. But it's a new product, so we're still kind of, figuring a lot of this out and kind of seeing, how it's the consumers responding to the product. So it's kind of a new, interesting thing to follow in the industry.
But why do you think the demand of man-made diamonds is a little bit lower? Is it because they're not as beautiful, or are they just not as luxurious as natural diamonds?
Yeah, I think that's kind of the key word. So, when we look at diamonds, it's a luxury product. It's not practical. People buy diamonds because they feel good, not necessarily because it's, the lowest price thing that they could buy. And, a lot of the times, it's gifting, and it's you're kind of giving something that's special or unique that you wouldn't buy in a normal situation. And again, I think it's really important to understand that, like you said, it's a luxury market. And when you look at the way that consumers perceive luxury, a lot of it's based on effectiveness and marketing and branding, and we see that across the luxury landscape. And I think it's definitely the case with diamonds as well. So I think as we look into the future, the natural diamond industry is going to continue to be pretty aggressive with its marketing approach to the product. Historically, you look at the Diamond is Forever campaign that De Beers is so famous for. I think that's kind of what made diamonds, what they are today. And I think the industry understands that, and the industry is going to continue to, market its product effectively. And I think that's how it's going to be able to continue to distinguish, itself from the man-made diamonds. But I think we can get to a point where, man-made diamond sales and volumes, could exceed natural diamonds. It's a manufactured product. We can produce as many as we want. They're going to be, I think, at a much lower price point. But again, I think it's going to kind of create a market of its own, if you will.
Mm-hmm. I think it's fascinating that a diamond is forever, and it's the symbol of love. That was when I read the article about De Beers basically creating that campaign. They've almost cornered the market for themselves there based on that. I think that's a fascinating and well done for them to them for doing that. Where do you think then? What about the different types of diamonds? You've got sort of mega rocks and then also coloured diamonds. But then of course there's gemstones as well, isn't there? And then some would argue that the gemstones are far more beautiful than a diamond. Where do they kind of sit with diamonds in the jewelry market?
Yeah, it's a wide market, and the pricing of diamonds is very wide depending on what we're talking about. And it's a non-renewable natural resource, and typically the larger, the higher quality of the diamond, the exponentially more rare it becomes. And that's why I see these big pricing differentials where, one of the big miners in South Africa, Petra Diamonds, they recovered a beautiful, I think it was like a 30 or 40 carat blue diamond with really good color, and they sold it for $40 million in the rough. That's not even polished yet. And then, on the low end, you'll see, small, lower quality diamonds, sell for under $100 a carat. So we have this huge wide-ranging market for diamonds, and I think that's kind of one of the things that makes it, complex for a lot of analysts that maybe are more generalists and don't really focus in the industry. It's how nuanced the market is, and diamonds lack fungibility. So there's all these, there's tens of thousands of different categories. Then you get into the polish with the different shapes, but they're all different markets. But I think when you look at kind of what drives revenues in the industry, it's that kind of bread and butter engagement ring. So it's going to be, say, the 3/4 of a carat to 1.5 carat colorless, polished diamond that typically found in a solitaire. And that's, I think, if you kind of watch a proxy for the industry, that's kind of maybe the area you want to look at. But there's all these different, segments, of the industry, and they all have their own market.
Mm-hmm. And you mentioned there about sort of that rough diamond selling for that incredible, was it $40 million? You say $40 million. What is the process then? So you can sell the rough diamond, which is effectively just, it looks like a rock, I suppose, a nice pretty rock, and then it would go into the cutting process. And can you just maybe tell us about the process and how it's cut and why it has a certain shape, and is there any wastage, that kind of thing? How does it go from rough and then move up the value chain into cut and then make its way to market?
Yeah, it's a good question. So I think if we look upstream, the miners, so the large majority of rough diamonds are produced in Russia, Southern Africa, Australia before the big Argyle mine closed last year, and then Canada. So those are kind of the primary sources of rough diamonds. From there, I would say, 90% at least in volume of those rough diamonds go to India. They're the specialists in manufacturing. They're the cutters and the polishers. From there, the diamond will go to, a jewelry manufacturer. And then, from there, it will go to a retailer. And in between all of those, segments, you have, wholesalers and traders, which I guess further convolutes the supply chain. But that's a typical supply chain. And then you have companies like Tiffany. So Tiffany's the largest, fine jeweler in the world. They have a big global presence, and one of the big moves in the industry is source provenance. So customers want to know, where did the diamond come from? Could you tell me the country it came from? Could you tell me the mine that it came from? Can you tell me when it was mined? And I think customers want this information because if they have that, they know it's not a conflict diamond. They know it's a real natural diamond. Perhaps it makes it more interesting. You kind of have that provenance story, which, kind of makes it more fun, and it kind of gives you a story to tell. And I think if you look at a company like Tiffany, they're vertically integrated. So they have, upstream supply, they have, in-house manufacturing, then they have that big global retail network. So a company like that's vertically integrated. And they've kind of been one of the first company that's been able to, actually tell the consumer, in the store, where all of their diamonds came from. And I think that's kind of the direction the industry is trying to go and eventually get to that point. But as we were just talking about it, it's a pretty convoluted supply chain if you're kind of just an independent that's not vertically integrated. So these are one of the things the industry is trying to figure out. How could we kind of have this diamond go through this convoluted supply chain and still be able to tell the customer where it came from? And that's where these blockchain technologies and a lot of these cloud computing and the industry is trying to utilize the technologies that are now available in order to do that.
Yeah, to give transparency to the blockchain. Yeah, didn't think of that, but that's a great way to utilize the crypto world. And so the typical shape of a diamond, then, why is it designed in that certain way? Is it just because it fits nicely into a ring, or has someone designed that and that's just accepted as the normal look?
Oh, right. So I think it's about reflection. You call it like brilliance. That's the way that the light reflects in a diamond. Okay. And when you see a diamond in person, it really is pretty much, there's nothing else like that. The way that it reflects light, the way it looks in person really is, it almost is like supernatural. It's really unique. And that's all about trying to maximize that, that light reflection. And I think that's why the round shape is probably the most popular, because it reflects light the best. But then you have, other shapes. You have ovals, and you have, pear shapes. You can have heart-shaped diamonds. So it's like anything else. The industry tries to be creative, but I think the round shape is the most popular because of the way that it reflects light.
And what about wastage when it's being cut? You can't smelt it.
Good point. Yeah, that's called the yield, and that's probably why you don't see more heart-shaped diamonds. Heart-shaped diamonds are really, really cool looking, but they have a lower yield, so there is more waste. And the waste is used for smaller stone settings where you'll see like a pave setting where will be a bunch of small diamonds in a piece of jewelry, or they'll do a large center stone and maybe small diamonds around it to embellish it. So typically they don't waste any. They'll just use it for smaller set diamond jewelry, or there'll be I guess at the very end kind of abrasive powder that's kind of left over. But yeah, the yield's I think a big part of it, and manufacturers are always kind of trying to look at how do we maximize the yield, but at the same time still supply the consumer with the shapes that they want.
Mm-hmm. Mm-hmm.
You already touched upon a little bit the different players in kind of the diamond industry. So the miners, the manufacturers, Tiffany's. Are there any other players that we've missed that are very important to note?
Yeah, so again, if we maybe start upstream, we look at De Beers, Alrosa, Rio Tinto. Then you have some independent miners, Petra Diamonds, it's London listed company. Gem Diamonds, London listed company. You have Lucara Diamond, it's a Canadian company. They have a key asset in Botswana called the Karowe mine, and that mine's famous for producing some of the largest diamonds in the world in recent years. And then you have a handful of exploration companies. I would say there's maybe a small handful in London, a small handful in Canada, listed in Toronto or Vancouver. But it's still a relatively concentrated industry with the manufacturers in India. These are almost all private companies. Some of them are very large corporate players where they'll have thousands of employees, but they're privately held. And then in the retail end, you have like you said, the Tiffany companies of the world. Then you have the LVMHs and the Richemont, which are these large luxury conglomerates that hold subsidiaries like Cartier and Van Cleef. In the U.S., you have Signet Jewelers. That's the largest jeweler in the U.S. They have well-known brands here in the U.S. and that's an important company because it's the largest jeweler in the U.S. and the U.S. is the largest market. So the U.S. accounts for almost half of global diamond jewelry demand. So it's kind of a key market. And then you have, you have retailers in India and China. Chow Tai Fook's one of the big, retailers in China. That's an interesting company because they're expanding so rapidly. They're opening, thousands of stores during the pandemic. Last year, they even opened new stores. So it kind of gives you an idea of how strong that market is. So yeah, it is a relatively concentrated market. I think if you look at maybe the public companies, but there's still enough that you can kind of cover and kind of get an idea of what's going on. But if you look at, say, like the retailers, it's fragmented in the number of independents there are. So I would say, if you look here in the U.S., independent jewelers, probably represent, 3/4 of the jewelry stores in the U.S. So it's still kind of a unique industry in that regard.
And out of kind of, let's say, these three groups in rough diamond two in the shopping windows, so miners, manufacturers, and retailers, who's making the highest profit off of this market?
Yeah, so they're all different business models, and they all have their own challenges. I would say upstream to the miners and the retailers probably have the most pricing power, I think, in the supply chain, and they probably have the highest margins. The manufacturing business, it tends to be low margin, high volume. So I think there's economies of scale is kind of a key part of that. And then I think you look at the retailers in a Tiffany, and I mean, they have nice margins, but they spend a tremendous amount of money. I think in recent years they spend $400 million in marketing. I mean, just to give you an idea of how much they spend on marketing, and they could get a premium for their a premium price for their product because of that brand that they built over years and years and years with millions and millions of dollars. So I think that's kind of the best way to look at it. And then you have companies that just try to be that try to be just maybe a low price retailer where they're selling just generic diamonds, trying to compete on price. So you kind of have everything. But it seems when you look at maybe growth in the industry, it seems as if branded diamonds and jewelry brands tend to be growing the fastest right now. Consumers like to associate with the brand, and again, I think with the brand transparency, consumers feel they get some transparency that you may not get with a generic diamond. Again, if you buy a Tiffany diamond, you kind of know where it came from. That they have a reputation behind that diamond. I think customers find comfort in that.
Mm. And what about security of supply chain going forward then, Paul? Do we need to be aware of a supply crunch, or do we need to be discovering new mines, or what does it look like in the future? What's currently out there and exploration going on? Yeah,
so I think I think the industry does need new supply. Kind of the end of this decade, I think there will be a need for that. There are a few projects in the works. But again, I think the way to look at this is it's price driven, and I think this is the case with a lot of materials and a lot of commodities that there are assets that diamond assets that are viable that are not developed now because at current prices maybe they aren't economic enough to get the investment to develop them. So I think as we see prices go higher, you will see development of some of these assets. And that goes for gold or copper, base metals. I mean, you pick it. It's an assets economics is going to change based on what the commodity price is. So, and that's certainly what we've seen over the last 10 to 15 years in this industry. And I think we're getting to the point in this cycle where higher prices will drive new exploration and development. And I think the timing will be right, because I think by the end of this decade we are going to need a refresh in some of this supply. Okay. Do you want to ask about the criminal side?
I mean, we do see a lot of mining going on in Africa, where political context is a little different than, for example, the US and Europe. With that also comes a criminal side to it. How would you kind of touch upon that?
Yeah, I mean, it's something that I think has plagued the industry for a long time. I mean, I think what I would say is that the large majority of diamonds produced globally are by these large commercial companies that are highly regulated. I think when you run into some of these problems, it's with the less regulated countries where you kind of have independent artisanal miners mining diamonds with their bare hands, in creeks and riverbeds and that sort of thing. And it's a challenge for the industry because the industry can only do so much. I think in jurisdictions where the government's ultimately in control. So I think, we were talking before about, supply chain transparency and being able to tie a diamond to its provenance. I think that's why this is so important for the industry, because I think in a perfect world, if a consumer knows where the diamond came from, they're only going to buy diamonds that came from a clean source. And I think that's the industry's job to provide that information. And hopefully the customer will make the right decision and only buy diamonds that it knows, come from a legitimate source. So I think that's kind of I think one of the biggest changes in the industry over the last 5 years or so. This is becoming more and more of a priority. And again, I think it's kind of, leveraging the availability of technology that, we now have to kind of make this a reality. And again, you see a company like Tiffany kind of leading the charge there, but I'm hoping that, in the next 5 years, hopefully definitely by the end of the decade, consumers are going to know where the large majority of diamonds the retailer came from. And I think that's really kind of a key to solving these problems.
Mm-hmm. And is there an issue? I mean, do criminals use it for money laundering and that kind of thing? Is that something? Is there a little bit of a criminal underworld going on with diamonds, or not any more than cash or any other kind of valuable commodity?
Yeah, I mean, so I think if you look at diamond, it has the highest, value to size and value to weight ratio of pretty much anything else, right? I mean, you could fit a $40 million diamond in your shoe, so it's kind of unique in that regard, and that's maybe why diamonds are tied to some of this criminal behavior. It's not really an area that I'm an expertise have expertise in, but diamonds are definitely kind of unique in that size to value ratio, and there's really nothing else like it.
Yeah, I went through UK customs recently with some silver in my bag that I should have declared. I didn't know that, which I did declare. And one of the customs agents told me that just a week before, someone had gone through 40 million pounds worth of diamonds in their pockets. I thought, okay, that's incredible.
Yeah, it tends to be you tend to see a lot of movies and TV shows that try to incorporate that. It's definitely interesting. And I think we were talking about lab diamonds before, and sometimes people ask me about, that, and if it's going to, have a significant impact in the natural diamond industry. And like the one thing that always kind of comes to mind is you never see stories of criminals stealing, lab created diamonds. It's only natural diamonds. So I think that kind of speaks for itself.
Yeah. What about the secondary market, Paul? I'm thinking because when you buy a diamond and you almost keep it for life, or you pass it down generation to generation. So, and you also, I don't know how much recycling if you can't smelt it down and use it again. So, what's the value of second-hand diamonds compared to brand new ones? And I guess that must as well. Locking away those diamonds in private hands will effectively limit the supply long term. Is that a factor to consider as well?
Yeah, I think it definitely is. So I guess a few things. The first thing I would say is that's not the secondary diamond market is not a huge market. And the reason it's not a huge market is because there's really not an advocate for it. I mean, the miners want to sell new diamonds. The lab diamond companies want to sell new lab diamonds. I mean, everybody wants to sell kind of new supply. So it doesn't really have a big advocate. The second thing is just the fundamental challenge of diamonds. Like we were talking about before, there's so many different categories. The valuations between those categories is so nuanced. So it really kind of takes an expert to really get involved in that business. And I think if you're, say, a pawn shop owner, there's hesitancy because you have to know what you're buying, and the price could vary greatly depending on what you're dealing with. So I think that's kind of another challenge. But I think it's in the industry's best interest to kind of push this, because again, we talk about the green economy, and I think there's there's nothing that's going to have a lower carbon footprint than a recycled diamond, or I guess gold needs to be smelted, but with diamonds it's just kind of cleaning it, put it in the jewelry cleaner, and it kind of looks as good as new. And I think that could be an integral part of the industry going forward. It just doesn't really have an advocate yet. So we'll kind of see where that goes. But yeah, there's certainly a huge supply of diamonds in the secondary market if somebody was to unlock that.
But the recycling of diamonds, doesn't that go a little bit against kind of the moral or like the emotional value of diamonds? So a diamond is forever. We talked about people getting buried with their wedding rings. So kind of the recycling of that wouldn't seem the most logical step.
Yeah, there is like this strange stigma where a lot of people don't want somebody else's old diamond, and And again, I think that kind of gets into the consumer psychology, part of this industry and how interesting that is, and why do people buy diamonds and why do they pay so much for diamonds and that sort of thing. And that's certainly been, I guess one of the key areas why maybe, that secondary market really hasn't picked up. So it's a good point to bring up for sure. It's interesting. And maybe some of that is, cultivated by the industry. But there definitely is that stigma of buying somebody else's old diamond.
Yeah, indeed. Okay, well, just to finish up this podcast, I want to just talk about the diamonds as an investment, because it's precious metals, silver, gold. People buy it to store away wealth for the long term. Is there a market for investing in diamonds to lock away wealth for the long term, do you think?
Yeah, so the biggest challenge, again, it gets back to what we were talking about before with that fungibility, where diamonds they're so, each one is so different, and the pricing is so different, and it kind of makes it difficult to create a mechanism that makes a diamond fungible. Now there is, there's a company that's focusing on that right now, where they're trying to kind of segment diamonds of similar value and rarity and kind of commoditize it, and we'll kind of see what happens there. The company's called the Diamond Standard. Based here in the U.S. So there have been attempts over the year. That's probably one of the best attempts I've seen so far. But again, it's kind of that fungibility issue that's kind of always been, I think, the biggest challenge. Whereas, gold, an ounce of gold is an ounce of gold, an ounce of silver is an ounce of silver. But with diamond, you can't really say that. So I think there is, demand for a product like that. It's just kind of coming, kind of getting over that hurdle of fungibility. So we'll see what happens. But historically, I think when you look at investment in this industry, the performance of the really rare, the really high-end diamonds are certainly the ones that have outperformed. And when you see investment, it's typically a high net worth individual buying $1 million or a $5 million or a $10 million diamond and kind of storing it away in a safe deposit box somewhere. You're seeing you're certainly seeing growth in demand in Asia for that. And that's kind of where you see it. But I guess on a more mainstream level, there's the fungibility issue has kind of been a big challenge there. Okay,
I just fancy having a diamond or two, adding it to my pot of precious metals that I have. So it's just,
it does have a different correlation. So I guess it could definitely be looked at as a portfolio diversifier, but it's typically people that just have so much money they don't know what to do with the market in a different type of asset, and they're buying a $10 million diamond. So that's
okay. Well, I'm not there yet. You might be, Lois, but so do you have any final points for Paul? No, all good. Well, a final point from me would be: what's the future look like, Paul? Is it bright? Is it sparkly?
I think we started off the conversation talking about how I think the industry was oversupplied for most of last decade. We're now in a complete opposite situation, where if anything, the market's undersupplied. When we look at some of the miners, we look at Russia's Alrosa, they've actually had an inventory deficit this year. They actually had to borrow stocks from the government, precious stone and metal stockpile to cater to their customer demand. So we have, I would say a healthy market from a supply standpoint. We have a healthy market from a demand standpoint right now. So I think, for the time being, all systems are go. And again, it takes so long to kind of bring a new mine into production. I mean, it could take, anywhere from, 5 to 10 to 15 to even 20 years to bring a new mine online. So you kind of get an idea of what supply is going to look like at least, 5, 10 years into the future. So I think the supply side of the industry is relatively healthy. We're continuing to see significant demand coming out of China, and the US at the moment's, very healthy, and that's the biggest market. So at the moment, things look pretty good. I mean, there's always, concern of, macroeconomic slowdowns or something like that. Yeah. Diamond demand is correlated with, GDP, especially in the US, China, India, Europe. So that's kind of, you got to kind of keep an eye on that. But for the moment, it's been a difficult few years for the industry. So it's kind of nice to kind of enjoy, the good fundamental picture at the moment.
Indeed. Well, thank you very much for your time. Thank you very much for painting the picture there of the diamond market and answering some questions that I've had for a little while. It's been a pleasure having you on the podcast, Paul. Thank you very much for your time.
My pleasure. I enjoyed it.
Thank you. Bye-bye. Thank you for listening to another podcast from Market Musings with Ben and Russell. Tune in next time.